Bloomberg Audio Studios. Podcasts, radio, news.
Morgan Stanley's Mike Wilson writing import cost exposure for S&P 500 industries is more limited thus far, given the combination of the countries in scope and the exemptions seemingly still in place. Mike joins us now for more. Mike, good morning.
Good morning, John.
Have we actually been tested? That's the question I've got for you, based on the note you put out over the weekend.
Well, yeah, I think we keep getting tested back and forth, and I think Anne-Marie did a brilliant job of kind of describing yesterday. It's just another example of the president controlling the narrative back and forth. You know, maybe the timelines now, I mean, he lets things go even shorter, and then he comes back and reverses. And I totally agree. I think it's about trial balloons. It's no different than Fed policymakers. It's no different than other policymakers coming in and they trial balloon it to see how it will impact the market. So have we been tested? Yeah, we've been tested severely in the first 3 or 4 months of the year. We had a bear market. Stocks were down 35, 40% over the prior year. So I mean, we had a bear market, and so people now are looking for I go, well, you missed the bear market. We had it. You know, we bottomed in April, and all the indicators we look at from a rate of change standpoint have inflected sharply. That's what we wrote about in our mid-year update, and it's even surprised us to the upside. I mean, the earnings revision breadth is explosive, and so you just can't deny that. You can't deny the fact that companies are good at mitigating tariffs, for example. Import prices really aren't up that much. So the question is, who's eating these tariffs? That's the big question I hear now from clients. It's like, well, we're collecting all these tariffs, but where are they? Some of them are on the balance sheets of companies. It hasn't flowed through the cost of goods sold yet. Some of them are from exporters. They've discounted their pricing. They're eating the tariffs. And then some of it's going to get passed on to the consumer. That's to be determined still. And so as we've been saying, the third quarter is probably the quarter of risk, where you'll see some of this flow through to the cost of goods sold. I don't think this is a massive correction. It's a 5-7% correction. For some companies, it could be bigger. But this is the quarter of risk for where the tariffs will start to hit. But the market's already thinking about this as a temporary impact. And 26 now, on an earnings growth standpoint, is looking better.
Is that a correction you'd be looking to buy then?
Absolutely. We're looking to, I'm hoping we get a pullback to some degree. I think a lot of clients are looking for a pullback of some kind. They've been surprised we haven't gotten one. But this is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, right? The rate of change is accelerating beyond what you expected. So it's just, I think the pullbacks will be short and shallow. Maybe there'll be another surprise, another test of some kind that will cause something more severe. But I really can't see more than a 5 or 10% correction given what I see now in the landscape.
When you think of tariffs, though, I think you're talking about the vis-a-vis country tariffs, right? The reciprocal. What about the sectoral tariffs? Does that make it more complicated?
Absolutely. I mean, and that's one of the reasons why I think a lot of investors have thrown up their hands and the market is kind of looking past this, because there's so many carve-outs. I mean, even the USMCA, right? The exclusions, and that's what we wrote about this weekend. So a lot of the tariffs on China go, they go through backdoor through Mexico. Well, a lot of that's been excluded. So the 25% tariff doesn't even end up hitting that. And then we have the 232 exclusions. We just saw that now, they can sell semiconductors into China again. So like there's these carve-outs, and it's very confusing. My base case view, and has been this all year, is ultimately I think that what they're going for is a 10% import tax, basically a consumption tax. And that's where we're going to land writ large. Now, we're not quite there right now. If you do the math, it's like 16, 17%. But ultimately, if we get to a 10% import tax, companies can deal with that. You raise $300 to $400 billion of revenue per year. I mean, it's not a bad strategy.
Does the one big beautiful bill tax cuts offset that import tax?
Well, that's exactly the strategy, which is that instead of taxing companies and private companies and individuals, you're sharing the tax now through exporters, importers, and consumers, and then let the market figure that out. Like, figure out where the tax can get allocated. So what we're moving from is an economy where capital has been allocated by government to an economy where capital is being allocated by private corporations. That's the beauty of the big beautiful bill, is that you're basically shifting the economy mix from a publicly driven economy to a privately driven economy. Something we talked about 6 to 8 months ago, right?
But is there a fiscal impulse, given the fact that really the crux of the one big beautiful bill is an extension of current policy?
That's right. So there's no incremental fiscal in the traditional way you think about it. However, there's a massive positive impact to cash earnings for corporations and an incentive structure to start investing. Something that companies have not been doing for the last 3 or 4 years is investing in CapEx. The bill basically encourages them to spend money on capital goods and R&D, something that we need to do to grow down the road.
Let's build on some of this. You talked about the broad-based earnings revisions. Is that more than just AI? More than just big tech? Where else are you seeing that?
So it's been led by the Mag 7, so to speak, but no, it's actually fairly broad. Now, it is a larger company-driven sort of revision factor. So the small the small companies still aren't seeing it yet. That's why we've been underweight. We've remained underweight the smaller businesses. Now that could change if the Fed starts cutting rates. That's something we're thinking about for 2026. But it is a fairly broad expansion. It's financials, it's industrials, it's some of the software stack, which was kind of left behind over the last year and a half. So it is broadening out. And this is, I think, a function of, look, there is pent-up demand in the economy. There is pent-up CapEx in the economy. And some of these incentives now, some of these tax changes, I think, do give clarity to companies now saying, okay, we can move forward with our business. The legislative agenda is done now. We can look forward for at least 3 years, maybe not beyond that, but at least for the next 3 years, and we got to get on with our life.
What are the kind of companies you like at the moment? Industrials
and financials really are the two areas we've been really focused on, and software, because I think a lot of folks are too bearish on software. I understand why. I mean, AI, coding and all that. But at the end of the day, this is the part of the tech cycle where you've done the compute, and now the application layer has to get built so that dummies like me on tech can actually use this technology and become more productive.
When I'm walking past down the Hudson in downtown New York, and I look across the river to back office city, compliance, all of those workers that are working for these major financial institutions, and forgive me because many of them are watching right now and this might be a rather brutal conversation, how close are we to seeing some big cuts to the amount of people that work at these institutions?
Well, I mean, compliance is definitely one area that will be hit not only from AI, but also from just a change in regulatory environment, potentially. We don't really know. I mean, we're not seeing it yet. Okay, I mean, I would say that the AI concern about employment, I think, is real. We're seeing it, here's the lead indicator. So the largest companies who are very facile with data, okay, your NVIDIAs, your Metas, et cetera, are showing the ability to use this data. Microsoft, right, they're laying off people more and more because they're able to use this data. So the question is, can that translate into the average company in the economy? To be determined. But I think that, I don't want to make a statement here, that's not great for employees necessarily. But man, if you think about what that does for S&P earnings,
well, this is it, Mike.
Really, really positive. That's why the multiple keeps expanding, because that's what it's looking forward to.
The conversation for further down the road, and this is the next several years, you can have this really strange dynamic where the labor market data stinks. Mm-hmm. But the earnings coming out of these companies might be really powerful. I just wonder how far you can push that. How far can we push that?
Well, we're going to find out, I think, because I think companies, U.S. companies are really good at cutting costs, whether it's employees or, other types of expenses. And so, I mean, that's what they're going to do, because we're still in kind of a slow growth top line environment. So companies have to become more efficient. Plus, they have to offset some of these other things like tariffs and things like that. So, but companies will figure that out. That's why the market continues to go for the high-quality businesses. One other thing that we haven't talked about yet is last week's Supreme Court ruling, I think, was really fascinating with respect to the government's ability to do these, reductions in force, from the DOGE. And this could be also quite interesting development, where this is like the return of DOGE. Because I would say most people are disappointed that DOGE wasn't allowed to kind of complete the deal. They were kind of blocked. They weren't able to kind of reduce government headcount. And maybe this ruling by the Supreme Court allows DOGE to kind of return, and we could see headcount reduction in government, which is another type of a slowdown in labor, which won't affect the market, right? That's not great for government employees necessarily, but that will liberate, kind of the private economy once again.
Two parts of these conversations, when you talk about the fact that more capital being allocated to the private sector, not the U.S. government. But if you have companies laying off people because of AI, who has to step in to help what potentially could be high unemployment rates? It's going to be the U.S. government.
Yeah, well, I would hope that, instead of laying people off, you just make them more productive. I mean, ultimately...
That's what everyone says.
Yeah, but I mean, look, at the end of the day, if you look at the private economy for the last 3 years, this is something that doesn't get a lot of airtime. The private labor force has not really grown for the most part, okay? It's been a government-heavy, healthcare-heavy, education, like state and local jobs. And so the private economy has been operating with fewer employees already. This is not a new deal. I mean, companies are, once again, are really good at being more efficient. So my hope would be that we could just grow with fewer people. By the way, you have less immigrants now, right, because of the shutdown of the border. So we kind of need this. We need to fill that gap of making the people who are in America more productive, and so we can grow the economy.
Mike Wilson, smart as always. Good to see you. Thank you, sir.